Hello, everybody, and welcome to our event on high inflation, the new normal. This event is being put on by the Richmond Center, which is a collaboration between Columbia Business School and Columbia Law School that has been provided by Richard Richmond, who is an esteemed alum from both schools. Today, we have a panel on an incredibly important topic of the inflation that we are currently experiencing. We haven't experienced inflation like this in over 40 years. And to engage in this discussion, we have three incredible individuals who have joined us. We have Abby Joseph Cohen, who recently joined us as a professor at the business school. Before that, she spent an incredible, prolific career at Goldman Sachs and other Wall Street firms. I should say that she began her career as an economist at the Fed during the period of high inflation. We also have Rick Mishkin, who is a professor at the business school, who also served on the board of governors of the Fed during from 2006 to 2008. So he experienced the early days of the global financial crisis. And we also have Trish Mosser from SEPA, who has served in two very important functions in the US government as head of research and analysis at OFR in US Treasury. And she also spent over 20 years at the New York Fed, where she was senior manager for the New York Fed's open market desk, overseeing financial market analysis, monetary policy implementation, foreign exchange and investment operations, and the analysis of financial stability. So I'm delighted to have you all here today and excited for the discussion ahead. To kick us off, I'm going to give each of you an opportunity to give some opening remarks. And just to give everyone a sense of what we're going to do, I'm going to moderate a discussion with our panelists, and then afterwards, we're going to open it up for some Q&A. If you have a question as we go along, please provide that question in the Q&A box, which you see at the bottom of your screen. So let's start with opening remarks. I'm going to begin we'll start with Abby, then we'll go to Trish, and then Rick. And the question is, how did we get here? And is this a repeat of the 1970s? Abby?
Well, first of all, thank you, Pierre, for including me in this panel. I'm very much looking forward to the discussion and to hear the comments from the other individuals here. How did we get here? I think there were a number of factors that led to the current high level of inflation. Let's begin with the pandemic and the idea that economic policy, not just in the United States, but in other countries as well, was really ginned up, if you will, to provide a lot of stimulus to bolster demand. The fear was that because of the pandemic and the shutdowns of economies, national economies and local economies around the world, that there was going to be a need to offset this. There were grave concerns about how high unemployment would get, and many nations provided a great deal of stimulus to bolster demand. And of course, what we found in the United States, as one example, is that while the recession was indeed severe, linked to the pandemic, it didn't really last that long, but we were nevertheless continuing to provide that stimulus to demand. And so when you have a lot of demand and combine that with some of the supply disruptions that we've seen, that is one recipe for inflation. In addition, we've had some special factors as it relates to the last couple of years. If we look at things like headline inflation in CPI, there were some special factors. I hate to use the word transitory because it's been given sort of a bad vibe, but there are some things that may prove to be transitory in this inflation picture. For example, if we go back and look at where some of the really big impulses behind inflation have come from, at least headline CPI inflation, let me give you 2 or 3 examples. One has to do with this enormous rise in used car prices on the order of 35 to 40%. Now, why did this happen? Because many families decided not to use mass transit. Many families decided to move to suburban areas, and they needed cars for the first time. That big increase in demand for used cars leading to the surge in prices probably won't be repeated. And from the standpoint of the arithmetic of CPI, if you're not going to get another big increase in these used car prices, that calms down the inflation. I'm not saying that the prices will go down, but for inflation to proceed at the same level again, those prices have to continue to rise at a rapid pace. That doesn't seem likely. Another example that was very important in terms of pushing up the headline inflation had to do with things like airline prices. And keep in mind that CPI is a change, and the comparisons that we're looking at now are relative to a period a year, 18 months ago, when people were not traveling, airline tickets were inexpensive. And so, yes, we have seen this very significant increase in things like airline prices and other forms of transportation. The question is, will it continue to rise at these levels? Not likely. Instead, I think the focus needs to be on core inflation, not headline. And core inflation is now showing some signs of easing up a little bit. I'm not saying that inflation is going back down to the very low pre-pandemic levels. We'll probably see, in my view, core inflation along the lines of 2.5% to 3% once we look out into something like 2023. And if I still have time, I'd like to answer the question about whether the 1970s is a good analogy. And I think it is not. The 1970s was a period of extraordinary inflation. It was inflation not of the high single-digit level that we're seeing now, but rather of double-digit level. It was a period in which interest rates were double-digit, mortgage rates 16%, as opposed to today's current 4%, and so on. And I think that there are some other things that were very different in the 1970s as well. One of the important catalysts, for example, then was the OPEC embargo. Yes, we have seen rises in energy prices now, which, by the way, began before the Russian invasion of Ukraine, but we haven't seen that there was the sharp embargo and the problems that occurred then. The problems now are in some ways, from a supply standpoint, less severe than they were then. But let's talk about the embedded inflationary situation in the US economy and other developed economies in the 1970s. At that point, which is not being repeated now, there were so many business contracts that included inflation escalator clauses in them. So, for example, many union contracts, almost all of them, the collective bargaining agreements between the workers and their employers, included cost of living adjustments. And so if there was an inflationary increase, that got reflected within a year within wages. That doesn't happen today. First of all, many fewer workers are represented by unions, and these COLAs don't exist in most collective bargaining agreements. Similarly, we're not seeing those sorts of inflationary escalators in standard business contracts either. In the 1970s, when wages rose, the employers were able to turn to their customers and say, look, our costs have increased, so we need to increase the cost of the item that we're selling to you. And it was built into the contract to have that flexibility. That doesn't exist today. So we don't have the same sort of easy follow through on inflation that existed in the 70s, and I expect a lot more pushback. As a consequence, my general assumption, as mentioned before, is we're going to start to see inflation calm down, but it will still be notably higher than it was in the period preceding 2020 and 2021.
Thanks very much, Abby. Trish, what are your views?
Yeah, well, thank you, Pierre. And let me agree with a lot of what Abby said, although not quite everything. I'm going to think about this from the central bank's perspective and frame it a little bit as how they get so far behind the curve so quickly. And it seems to me that there were sort of three forecasting mistakes and a very unfortunate timing of obviously geopolitical events. So the first of those is how temporary the aggregate supply shocks of COVID really were. They were not nearly as transitory as everyone thought. And then there are a couple of reasons for that. And it's not just global supply chains and commodities, but the unevenness of recoveries across the world played a role here. The advanced economies, who are the consumers, bounced back incredibly quickly, and the producers in the world did not. And that just added to the stress. Huge shift towards demand for goods and away from demand for services, which again created extra inflation pressures that were particularly international in scope. And of course, the recent geopolitical situation is frankly terrible for inflation, at least in the very short run, and is really adding fuel to the fire. The second, what I call sort of a forecasting mistake on the part of central banks, was not just the size of the fiscal and monetary policy stimulus, which was enormous. I completely agree with Abby that was a primary cause, but the speed. And that, if you combine that with the shift toward a demand for goods, there was just a massive leap in aggregate demand. And particularly the advanced economies, and the US most particularly, went from underemployment to and excess supply to excess demand in a matter of months. Just unbelievable speed. And I think one of the things that was forgotten from the very distant past, when we've had inflation and more volatility in inflation than we've seen in many decades, is the fact that speed matters in the Phillips curve. Closing output gaps, we know, can increase inflation. That's sort of the standard relationship. Closing output gaps really, really fast puts even more impact on inflation. And that was what I just made was an empirical statement. Last and not least, in fact, I think the most important reason, and the reason I'm a bit more worried than Abby, I think, about the more medium term, were really, really serious misjudgments about the impact on labor supply. COVID has had fundamental, and it seems at least medium term lasting, impacts on people's willingness to work, and particularly to work in certain types of jobs. The fact that it's services wage inflation that's higher now than anything else sort of tells you what you need to know, because the shift in demand has been toward goods. Rearranging the labor supply doesn't tend to be a quick process. We've been through this several times in history. And so labor force participation in many, many countries has simply not come back to where it was. And it's an open question as to how quickly it will come back. And when labor force participation doesn't respond, then you have economy-wide implications for inflation, not just inflation in certain markets. All of that said, let me completely agree with Abby's statement that this is not the 1970s inflation. It took more than a decade of expansionary fiscal policy at full employment, too easy monetary policy with a central bank that was always behind the curve, and a bunch of bad supply shocks to get into that mess. This is a mess, but it's not going to drag on for 10 years. It's clear that the central bankers are on top of this and know what they need to do. And so it's really not, in that regard, even in the same ballpark. Thank you.
Thank you very much, Trish. Rick, your views. You're on mute, Rick.
I want to give a little bit bigger picture on this. And it relates to something my mother said to me. And my mother always used to say to me, it's better to be lucky than good. And I thought my mother was brilliant, but it turns out, and only Abby is going to know who I'm referring to, this is a quote actually from Pee Wee Reese, who was a very famous ball player in the 1950s for the Brooklyn Dodgers. He's the actual captain of the team of the Boys of Summer team in 1950. The Fed is in a situation where they're going to be very unlucky, and they've been bad. And so I'm going to be very, very critical of the Fed. And I'm going to be agree with the basic points that both Abby and Trish have made, but I'm actually going to be much more depressing. So I'm going to be the true economist, the one who tells you all the bad things about the world. So let me actually talk about the policy framework of the Fed, which I think has been very, very flawed. And it's something I've been criticizing for over a year, and actually have written op-eds about it as well. So the first is the forecasting mistake. And I think that the points that Abby and Trish have made are absolutely correct on this. The Fed has talked about supply shocks and not focused on demand shocks at all. They pretty much ignored it. And they're right that if it's a supply shock, then it's going to be temporary and you should look through it. And in fact, as Abby pointed out, that's why you look at the core inflation on this. Trish, I think, is right that the supply shock was somewhat different. So it's actually not as temporary as usual supply shocks. So that's an extra feature. But that would have been tough to them come up with, which is sort of unconscionable in terms of their forecast. I still don't get why they did this, which is we had huge demand shocks. So there are two big demand shocks. The first is the Biden American Recovery Act, which I think was a very bad piece of legislation. It was not about recovery. It was a 1.9 trillion, about maybe 1 trillion was actually needed, but it was basically just a big spending bill at the wrong time. And even Larry Summers, a hardcore Democrat, has taken this view. So that was one part of the fiscal expansion, which both Abby and Trish have mentioned. The other that's very key is the fact that this is a very unusual type of a recession, because the demand shock was the supply shock was lockdowns. And also we had these supply bottlenecks. The problem with the lockdowns is that during that period of time, people actually found their balance sheets improving because they couldn't spend. When you start taking people out of lockdowns, they start spending like crazy. So I'm somebody who spends a lot of money on food. That's my whole relationship with my wife is all about eating together. We couldn't eat out for a year and a half. As soon as basically we started eating out, we were eating out like crazy and spending money. And that's what you should do. So both of those factors meant that there was a huge surge in demand, exactly as Trish mentioned. And in fact, the pent-up demand came back very quickly. Again, a point that Trish has made. So when you have a supply shock, we're supposed to look through it if in fact there's not a demand shock associated with it. But in fact, it's exactly what's occurring in this case. And I'm going to actually argue that we're not going to be in the 70s. So I'll talk about that later. But some of the elements of the 70s are here in the mistakes the Fed made. So that's number one, just bad forecasting. Number two is that the Fed has now, under Jay Powell in the last year or so, has deviated from a basic principle that the Fed has operated in monetary policy, is that monetary policy has long and variable lags. This is Milton Friedman's statement. It means you have to be preemptive. You have to get ahead of the curve. You have to anticipate what's going to happen and do what you need to do to keep particularly inflation under control and keep the economy from getting overheated. The Fed actually has abandoned that. Instead, they said, we want to just drive the economy to full employment. In fact, we don't even know what that number is. They thought 3.5% was the natural rate of unemployment, or the full employment unemployment rate. That looks like that was a mistake. This mistake actually was made in the 70s. So I'm going to actually draw more parallels to the 70s that Arthur Burns thought that the natural rate of unemployment was around 4% when it was actually quite a bit higher than that. And targeting that was very problematic. So that was the number two mistake. Number three mistake, which is something that I've done a lot of research on, has to do with the view the Fed had of the Phillips curve. So their view of this was that the Phillips curve is dead. And what we mean by that is that the tightness in the labor markets was not going to cause inflation to happen. And there are two flaws with that reasoning. One is that you may not know what the natural rate of unemployment is. And you might think it's 3.5% as the Fed thought, which in fact, given what's happened in the labor market, is clearly not the case. And some of the issues that Trish and Abby mentioned about this, I think are right, that the Fed didn't get that, but that was hard. But also, when you actually think about the way, understand what Phillips curves are all about, if in fact policy is preemptive, which means that you actually do policy to raise unemployment when you anticipate there'll be inflation a couple of years down the road, then in fact you will not see a Phillips curve. Because it turns out that this is actually a theorem from optimal control theory. And so in this case, You won't see a Phillips curve. It'll look like it's not there, but it's just hibernating. If you stop being preemptive, it'll come roaring back. And that's exactly what we're seeing happening now. So that was the third mistake. The fourth mistake, so I'm pretty tough here on the Powell Fed, is that they implemented a new strategy for inflation targeting, this so-called average inflation targeting, which is something that was actually a very good idea. I've been a strong advocate of doing this, but then they blew it. And how did they blow it? The Jay Powell Fed, Jay Powell, unfortunately, I think, has gone back a little bit to what central banking was like in the old days. He's not very good on transparency. He does not like being clear about what the Fed is doing. And there's been tremendous criticism of him for that on Wall Street. But how it actually hurt here was that they said, we're going to this average inflation targeting. It's 2%, but average. But they never told you the horizon. They never said, how long should we think that the average should be? If the average is not pointed out, in fact, if it's a very long-term situation, you say 20 years, then in fact, there's no longer an inflation target because you can be above the inflation target for very long periods of time and you still are okay on the average. So that actually has weakened the inflation target and the commitment to a strong nominal anchor, and it's weakened Fed credibility. So all of this is very bad stuff. It has some elements of the 1970s because that did happen to some extent. I'm going to argue, by the way, we are not going back to bell bottoms and to fros. So I had a beautiful fro in those days. I loved it. I had this dark, fantastic curly hair. I wish I still had it. We're not going back there again, and neither am I. However, then the Fed gets unlucky. And the unlucky aspect is the Ukraine war, which is both a negative supply shock and also it's a hit to demand. So this is sort of the worst of all situations. So what do I think is going to happen? I don't think we're going to be back to the 70s for the reasons that both Trish and Abby described, because we haven't spent 10 years doing bad things. We basically spent a year not getting it right. And that's hugely different. We don't see an explosion in inflation expectations, but there are some warnings that in fact, inflation expectations are getting unhinged. There's some very nice research by Ricardo Reese on this topic if people are interested. So we're not going back to the 70s, but, and also Arthur Burns was, now viewed as a terrible Federal Reserve chairman. The Fed is not going to make the mistakes that Arthur Burns made, which is he kept on accommodating, having very accommodating monetary policy when inflation kept on rising. That is not what's going to happen here. The Fed is going to do its job. The problem is they're behind the curve. And what does that mean? It means they have to raise interest rates by much more than they otherwise would have. So I'm anticipating that we're going to see interest rates to the level of 6% or so. So I think Abby is right. I think we're going to have inflation, which is too high. I don't think 2.5 to 3 is right. I think we're going to have 4 for the next year or two. And in order to basically get it down to the levels, which they'll get it down eventually, we're going to have the interest rates of at least nominal rates or federal funds rate of 6%. That's going to be very damaging to the economy, and particularly when we have the Ukraine war creating a very negative demand shock. So my view is that we're going to have higher inflation for longer than the Fed expected. It will come down. I think that Abby's right on this, and Trish is right that it will come down, but I don't think it's going to come down as fast as they think. And I think that the Federal Reserve is going to have much tighter monetary policy than people are anticipating. And we have the Ukraine war, and I think we're going to have a recession in the next year. So this is not a disaster. This is bad. We're not in the 1970s. We're not going to wear bell-bottom pants again. But on the other hand, we're in for some rough times. And to be frank, I think that the Fed is going to deserve a lot of the blame for it.
Thank you very much, Rick. And thank you all for your terrific remarks. I'd love to open it up for some discussion. You've all brought up numerous points. I wanted to touch on the point that Rick brought up about inflation expectations. And if you look at market implied inflation expectations over 5 years, over 10 years, they're all on their way up. Even the 10-year is accelerating. I'm not sure who wants to tackle this one, but perhaps Trish, what do you make of that? Should we be worried about inflation expectations? Or is this, I mean, and even those expectations are quite high. They're certainly not at 2%.
Yeah, no, that absolutely. So regarding inflation expectations, we should be worried particularly if the central banks don't act the way they should act. And if inflation continues to really, really accelerate over the course of the summer. Long-term inflation expectations actually very far out. So example, say 5-year forwards, right? Are the break-evens right now are sitting at about 2.5%. That's where they sit when the target is expected to be 2. So the markets at this point, and by the way, the surveys of households and businesses look surprisingly the same. Big jump in inflation expectations over the next few years, and then back down to the target. The problem, of course, is the longer this goes on, with all this excess demand right now in most of the advanced economies. Japan's a different case, but with all the other advanced economies, the worse this gets. And I have to tell you, one of the most negative things I've seen about for long-term inflation expectations was a little piece that the New York Fed did looking at the distribution of inflation compared to last fall and last summer, where it really was sort of specific goods and services and commodities that were kind of driving the overall inflation numbers. It's very widespread across services, across all kinds of industries now. That's not a good prescription. If that goes on too long, then you get into businesses starting to do what they did in the 70s that Abby pointed out, of starting to index things. And that's where you start to get yourself into much deeper problems. So I'm a little worried. I'm not as worried as Rick. I think I'm sitting in the middle here. I'm not sure about that, but I am a little worried.
So should I jump in, or Abby?
No, well, I mean, I'm not sure if Abby, if you wanna.
Yeah, there's so many interesting comments that were made. Let me just limit myself to 2 or 3 points. First of all, within the financial markets, one thing that's very clear to say is that 2022 has not turned out to be the year that so many people expected, nor has it turned out to be the year that policymakers expected, right? The Fed had thought, along with most investors, that there would be a relatively smooth path. Yes, inflation was higher, but it would start to ease off. GDP growth, which was so robust in 2021, would also start to decelerate, but in a relatively smooth way. And one of the things that has changed, of course, over the course of the last 2 or 3 months has been that the consensus is now very much dispersed. We have people within the markets who believe a scenario very much akin to what Rick laid out. There are those who believe a scenario even more sanguine than the one that I laid out. And the sort of probabilities that are assigned to the forecast that I presented, which is sort of like the mode now for the consensus, the probabilities that get assigned to it are now sort of 50%, as opposed to the 75 or 80% that it might have had in February. So that's one very big and important change. The other thing that I would indicate is that maybe we need to be a little more kind in our analysis of the Federal Reserve, because when Arthur Burns was chair, and I'm not saying he was a good chairman, but when he was chairman, the Fed was the central bank mainly for the United States, right? There was very little concern at that time in terms of the rest of the world. In fact, having worked at the Fed in roughly that vintage, the general sense was the rest of the world is a statistical error when we do our domestic forecasting. That's now a very different kind of situation, right? At that point, something like 5% of the Fed's research staff looked at global economies. Now it's 65%. So there's a very big difference. And so this is a Fed that is dealing not just with some of the problems that Rick laid out in terms of interest rates being too low for too long. For example, in the United States, we got to the point where not nominal, but real interest rates were around 0. look at what's going on in so many other developed economies where nominal rates were negative, right? And real rates were really negative. So this is a Fed that needed to worry about not just what they thought was appropriate, but the overall global environment that they were dealing with. And then, of course, there were the two, what many people refer to as the black swans, the pandemic and not understanding how the pandemic was going to play out. We see, for example, that the expectations in early 2022 that most of the severe economic consequences of the pandemic were easing up. Well, that was the expectation 2 months ago. As we take a look at China now, not the expectation. Their vaccine failed, very low efficacy rate, so they're forced, in their view, to have these strong lockdowns. And it's not just the Chinese economy, which is now skidding toward, I don't want to say into a recession, but toward a recession, but the impact on the supply chain from China and through the rest of Asia, and the impact that that's going to have in terms of aggregate global growth. That's an unexpected black swan this year. And then, of course, the situation in Russia, Ukraine. At the beginning of this year, most equity analysts, most analysts in the corporate sector said, this is the year that Europe starts to look better. In fact, we began to see that the consensus GDP numbers for Europe were actually rising until February 24th. And we now see that since the Russian invasion, there have been dramatic consequences for expectations in Europe in terms of GDP. We now, of course, see the consequences because of the disruption of energy supply from Russia to Europe and so on. And one of the things that I'm very conscious of is I can use my magical valuation models. I can use my magical economic models and so on, but I recognize that my toolkit doesn't include these geopolitical issues. It doesn't include the foreign policy matters. It doesn't include the military matters and so on. So I'm going to give you one example. In early 2022, the PE ratio for the S&P 500 was 24 times earnings. It's now 16. So we went from 24, which is the 99th percentile, not very attractive, down to 16, which is sort of the historical average. One would say, valuation has been restored. However, the risk tolerance of investors has been damaged significantly. And so one of the things that we don't know, for example, is at what point investors say enough is enough. The bad scenarios already priced in. And by the way, we of course have seen an even more dramatic change, not in equity prices, but in bond prices. There has already been a very significant reaction. And we can talk a little bit more about whether much more will happen or whether some of the unfortunate consequences of inflation and so on have already been properly priced in to these markets.
Abby, is an appropriate characterization of some of what you've said, that to some extent, recession in Europe, zero COVID policies in China could themselves be disinflationary by reducing demand abroad. That could push us into more of a soft landing scenario that that the Fed is looking for. Is that an appropriate?
I think that is an appropriate way to look at it, Pierre. And the other thing to point out is this. Trish appropriately began to talk about Phillips curve and so on. And what I'm finding is that not just in the US, but around the world, rather than looking at unemployment rates, which we all know are, shall we say, not the best metrics, but if we look at a very simple measure like what's the gap between available workers and available jobs, we're seeing some rather extraordinary things happen. So for example, in the United States now, particularly in some of the low-end service jobs that Trish was referring to, is that we have never seen a gap of the sort we now see between available jobs and available workers. And when we look globally, it's not just labor force participation, it's actually population growth, right? So if one thinks about the last 4 decades, one of the reasons the United States performed much better than other developed economies is that we had faster population growth. But 60% of our growth in labor force, net growth in labor force the last 10 years came from immigration. The last 2 or 3 years, that has been dramatically reduced. If we do the same sort of analysis in Europe and so on, we see that the net change in labor force is basically zero for the Eurozone, mainly because of problems in Germany and Spain and so on, a little bit better in Italy and so on, but it's not a healthy picture. And of course, in Japan and China, we're looking at numbers that are also very, very low. So when we think about aggregate economic growth, we need to look at these data as well.
Rick, what do you make of the likelihood of a soft landing? What we've heard from the Fed is that we've had successful soft landings in the past, and if it happened before, why can it not happen now? What are your views?
So I'm going to say it's low, and I'm going to differ with Abby on this view that the sanguine view that it's actually, there's not just a negative demand shock from the Ukraine war, but I think what's going on in China with a policy which actually was, I think, sensible at one point, but is actually disastrous now in terms of zero COVID policy, which I talk about in my course. I'll tell you why I think this has happened there. There's several reasons why I think that the soft landing scenario is not right. And that there would have been a situation, Abby, where I would have agreed with you. If the Fed had gotten ahead of the curve, had not made these policy framework mistakes, I think you'd be exactly right. We actually have some forces that are going to be deflationary and recessionary in the near future. And it's not even just the Ukraine war. The fact that China's locking down is a big deal. This is a policy where what's been so frustrating for me as an economist and worrying about in what happened in terms of discussion of COVID has been the inability of most politicians to ever think about trade-offs. And that's what we do as a living for economists. We always worry about trade-offs. Zero COVID policy was not a crazy policy at first in China. I think it actually made a lot of sense, given the severity and the death rates from COVID. When COVID becomes, instead of a pandemic, basically becomes something which is much less dangerous and very much more virulent, then the cost of actually doing lockdowns is much higher relative to the benefits because people are going to get COVID anyway. And so I agree that there's actually, the bad luck is not just Ukraine, and the geopolitics and I don't know genome, whatever you call it, but health things are important, are things that's very hard for us as economists to predict. And I do think that is going to be somewhat deflationary and also recessionary. However, this is the kind of situation you get into where it's dangerous when in fact you've lost credibility, when in fact you've gotten behind the curve. And that's what did happen in the 1970s. The Fed is in a situation where, and it's the timing, are we going to have a recession? I think we are. That's what we had in we had a very severe recession in 1980 to 82. We had 2 back-to-back recessions. And I think that these factors, which we can't predict, are actually now turning against us. The problem is that in order for the Fed to reestablish credibility, they must raise rates. So it's exactly at the wrong time to raise rates if you're purely worried about a recession. But on the other hand, in order to get control inflation expectations, they need to do it. Let me talk about Ricardo Reese's research, because I think it is very relevant to some of the things that Trish was saying. And that Abby was saying as well. When we look at things like the 5-year forwards, it doesn't look that terrible. It has gotten worse, but doesn't look all that bad because it actually was coming from a very low level. And by the way, I want to make an argument that the international issues are very important, but it's still true that the U.S. is the elephant in the room that squashes everybody else. And actually, one good thing that's happened for both Japan and Europe, and why they have to have a different type of monetary policy in the U.S., is that they actually had inflation expectations that were unanchoring downwards. And this actually helps them in that regard. And this is why I've been very critical of the ECB for the last 10 years or so, because they haven't been expansionary enough. I actually think that they do not need to be as tight as the US in this context. Ricardo Reis's research is really interesting because what he has looked at is inflation expectations, and most people look at the means. So when you look at the 5-year break-even, we look at the mean. When we look at or the median, we look at households' expectations. What he's done in his research, he said, let's actually take a look at the dispersion and differences in views. And what you find is that when differences in views become very large, even if the median or the mean has not risen that much, it's like a yellow flag. I guess that's the football or soccer term. It's a warning that things can happen. And it's actually what did happen in the 1970s. So I think we actually are in a more dangerous period. I think Trish is right that the longer this goes on, the longer that the Fed does not reestablish credibility, does not communicate better, the worse this situation can get. And I don't see a soft landing. First of all, it's very hard to do soft landings. Let's actually think about when the Fed has been successful in soft landings. They've not been successful when inflation is out of control and they have to basically get that inflation down. That's when they've not been successful. When have they been successful? I was actually at the Federal Reserve Bank in New York. Trish was actually my employee at that time. She was a colleague at Columbia. We've been good friends a long time. In fact, one of the few people I could talk honestly to about management when we were there. But the Fed actually engineered a soft landing in 94, 95. I was there when we did it. In fact, one of the things, but we did it in a situation where we actually did not have high inflation. There was credibility about inflation control. There was a little bit of a concern about getting it right. At one point, we actually did a 75 basis point increase, I think in early 1995, to make sure the markets understood that we were serious. And then once we did that, the markets got it. When you've lost credibility, it's much harder to establish it. The disaster is what happened in the 70s. That was almost impossible to reestablish. Then you had to get federal funds rate of 20% to get the situation under control. We're not in that bad a situation, but I do think that we have a real problem. And the ability of the Fed to actually do soft landings when inflation has already risen a whole lot and there's a lot of concern about unhinged inflation expectations, boy, it's really hard to do it. And the betting, I would be willing to take good odds that this is not going to be a case of where they're going to have an easy time of it, that I think they're going to have a hard time. And indeed, in other cases, it's not been easy to do. And when they've been able to be successful, they've had a good framework to start from. And that's not where I think we are now. So I'm much more critical of the situation. And I think that Abby's exactly right, that there's a lot of bad luck here. And that's something that we can't predict. And it's really terrible to not, if you're good and you have bad luck, it hurts, but it's not terrible. But to actually have made mistakes and then have bad luck is really pretty devastating. And I'm very, very worried about having these recessionary influences occurring at the same time the Fed has to establish credibility, needs to. And I think that's what Trish has said, that they need to do it. And I think the Fed will do it. The good news is Arthur Burns is not in charge. So I've been very critical of Jay on some issues. The Fed, by the way, I should say, was brilliant in 2020. They did a great job. So it's not that I think, in fact, I've been very critical of the Fed starting in about April. So Abby, I was a little bit ahead of the markets on this. On CNBC, I've been getting up and saying a lot of the same things that I'm saying now, and very skeptical. And I was wondering when the Fed was going to start to churn the super tanker, because it takes a while to do that. And they are doing it now, and that's good news. But I think that the likelihood of having soft landing right now is actually low.
Thanks, Rick. Trish, I want to jump off at a point that Rick mentioned, which is, the Fed faces challenges reestablishing credibility. But one thing that's true now, which wasn't true in 94, wasn't true in the 70s, is that the Fed has these additional tools involving quantitative tightening. And I'd love it if you could, given your experience working at the markets desk, New York Fed, if you could shed some light on how you think about those different tools and their ability to combat inflation.
Sure, I'm happy to. So could quantitative tightening play a role? It could. It's not just the policy rate anymore, as we all know. And the Fed's been very clear that the Fed is matching the aggressiveness of the way it's talking about future policy rate hikes with a significantly more aggressive roll off of the balance sheet. They plan to roll off nearly twice as many securities per month as they did in 2017. So 95 billion versus 50. So that's the first big difference. So if you like, the interest rate policy and the balance sheet policy are going to be much more self-reinforcing, as well as more aggressive. In fact, my guess is also that, like they did with getting out of QE fast, they will get into quantitative tightening very fast. They took an entire year in 2017 to get to just $50 billion. They sort of raised the caps incredibly slowly. They could do this in 3 months. I mean, you know, really, the treasuries are $60 billion cap every month, 20, 40, 60, and they can do mortgage-backed securities, which are going to be crudely 35 billion cap per month, just as quickly if they need to. Let me make a sort of technical comment about QT, and I apologize, this is a little complicated, but I think it's worth mentioning. A reminder, the 95 billion per month that was mentioned in the Fed's minutes is a cap on monthly roll off. They're not going to be selling securities or anything like that. They don't plan to do any of that stuff. That's a $60 billion cap for US Treasuries, a $35 billion cap for rolling off mortgage-backed securities. They're not going to let more than that roll off. Back in 2017, 2019, when they did this before, they actually didn't hit their monthly caps a lot of months. They actually ended up rolling off less. And one of the reasons that they were so slow was because they had nothing but long-term securities on their balance sheet. If you remember, QE 1, 2, and 3 was all about buying duration. The Fed was pulling duration out of the market. So basically everything they bought was 5 years and up. And a lot of it was very long, 10s and 30s. That's not true now. The QE that was done during COVID was across the yield curve and included even treasury bills. The Fed owns $325 billion of treasury bills now. They bought that much. So they have, and a lot more short dated coupons too, things that started out as 2-year notes. So they have a lot of treasury securities that are going to roll off in the next year and a half. So as they start the QT, and they're particularly going to be concentrating their interest rate increases, they're not going to be able to roll off everything, particularly the treasury portfolio at $60 billion. In fact, some months they'll have twice that amount that they could, that is going to mature. Now, the last time the Fed did roll off, if they had a month where they had, you know, too much maturing, they were very even-handed about, they rolled off a little bit of everything, and then they reinvested in a little bit of everything. But this time, if they decide to roll off just straight, they're basically going to roll off all of their bills first. They're going to be gone in 9 months, effectively, the treasury bills. If your point is to tighten financial conditions and slow down aggregate demand, then what you want to put back in the markets is more duration, right? You want to get long-term interest rates down. And so if that's what they want to do, then I think the question is, for the treasury portfolio, how will the Fed decide what to reinvest each month and what to roll off? You know, if you really want to maximize your impact on long-term interest rates and maximize your impact on aggregate demand, you'd roll off the long-dated stuff and keep the bills. And basically they could do that because they have such a large amount of the portfolio is going to mature. Let me be super clear here. What I just said is not a prediction. It's not a prediction. Really, really, really want to be careful about that. In fact, honestly, I'd be a little surprised if they did what I just suggested. But my point is that they could if they wanted to. And so it's going to be extremely interesting next week, I think it is, to see how they decide to do this. Because if they actually decide to roll off the long stuff, I think the impact could be at $60 billion a month. The impact on the long end of the yield curve and the shape of the curve could be pretty significant. I'm very glad that Abby is nodding her head. It seems as I said, I'll be surprised if they do it, but it's absolutely a policy tool and it'd be completely within their purview to do it. So time will tell what the Fed does. It's very clear, though, that they are going to use QT aggressively and in the same direction that they're going to do the interest rate rises. And I think that's the most important part of this.
If I can add just very quickly, Pierre, the financial conditions overall environment is very much driven by the factors that Trish has discussed, right? We're talking about interest rate policy, we're talking about policy, be it QE or QT. Also, equity prices are related to financial conditions, as are the currency markets. And with the sharp decline in the equity market, that has been yet another tightening of financial conditions.
Terrific. Thank you very much. I'd love to open it up to questions from the audience. We already have a few, but if you have a question, please feel free to type it into the Q&A box. Our first question is about the risk of the Fed tightening too fast. Rick mentioned 6%. Is there a risk that we tighten so fast that we end up having to go back down again because we've done too much? Perhaps I give that one to Rick and have others react. Rick.
Sure, there is. This is why it's so difficult to do to do a soft landing. It's very hard to do. And there's the trade-offs for the Fed has actually worsened because of this, because of the fact that their credibility is, I think, weaker than it should be. That means they have to push harder to raise rates, but then there could be an issue that you get a much more severe recession than you'd like, and then you actually have to backtrack. Now, there's some historical analogs to this, and how difficult it is to do this. So. When Volcker came in at the end of 1979, and by the way, Jimmy Carter never gets enough credit for this. Volcker actually told Jimmy Carter that if he appointed him as chair, he was going to actually get rid of inflation and raise rates to do it. And Jimmy Carter actually said, that's the right thing to do, I'll support you. And it meant that Jimmy Carter was never going to get reelected. So Jimmy's always sort of given a bad rap on a lot of things, but he deserves more credit than people actually give him, because he really was trying to do the right thing, just was not a great communicator about it. What happened is that the Fed raised rates to a very high level. There was a very sharp and short recession in 1980. Basically demand collapsed, and it scared the Fed. So what the Fed then did is it lowered rates. The problem was it hadn't reestablished credibility yet. And so then what did it have to do? It then had to go back up again. So it is very tough to do this. And if you end up making some of the mistakes I think the Fed has made, it's even harder to do it. So is the answer that the Fed may tighten too much and we can have a problem? Absolutely could happen. I think the Fed knows that it has to do something to get back credibility. They're talking about doing a Fed 50 basis point increase at the next meeting. That's very unusual, by the way, for the Fed. The Fed likes 25 basis points moves. It likes to do things in a smooth fashion to show it's not panicking. And yet it now knows that it basically has to do more because the real interest rate is given the inflation rate is so low at the particular point in time. So it's a very tough situation for the Fed. It's much harder to do. And this is why, no matter how good you are in the science of monetary policy, and maybe a little arrogant that we call it a science of monetary policy, but I think I teach this and I do call it that. I also talk about the art and how difficult the art is. And particularly if you didn't quite get the science right, the art is even more difficult. And I think the Fed is in a very tough environment right now. And the answer is absolutely yes, they could over tighten for sure.
Abby,
it's a tough job right now being a central banker. They deserve a little bit of it. That's why I'm so harsh about them. They deserve a little bit of to be harsh, but boy, they have a very tough environment that even if they have a maestro in charge who can forecast the economy very well, it's still going to be very hard.
Abby, your reactions to the question.
Yes, so two postscripts with regard to the Fed. First of all, I think the right athlete to be referring to here is Wayne Gretzky, the great hockey player, who said that I skate not to where the puck is, but to where I think the puck will be. And this is the essence of why it's so difficult to do monetary policy, particularly since the impact of it is not instantaneous. There is a real art form to it. So number one. But number two, I disagree a little bit with Rick now. I don't think it's going to be difficult at all to raise rates 50 basis points, because they're telling us.
Oh, no, I'm sorry.
And it's already reflected in the financial market.
I'm not disagreeing. I actually think it's exactly right for them to do 50 basis points. I'm just saying that the departure is an indication that they have to do much more quicker.
Yeah, but there also is, I think, under Jay Powell, a continuation of what we've seen over the most recent Fed chairs as well, and that is, I'm going to tell you what I'm going to tell you. And this is very different from the Fed that I grew up in which 3 months after there was a policy change, then something appeared in the minutes and you had to sort of figure it out. Now, Fed chair and other members of the board are basically saying, we think we need to be raising 50 basis points. Don't be surprised if we do. And the markets, the bond market, the fixed income markets, have an opportunity to respond in the meantime. And so what I'm looking at is not just the rate, the interest rate itself, but also the shape of the yield curve, because it will be not so much what happens at the very short end that will have an impact on the economy, because most borrowing in the economy happens at the intermediates, and much of what happens in financial assets happens at the longer end. So that's one point. And there's one other issue I'd like to raise, and that is we are exiting a period that was very long lasting, in which interest rates were simply too low. Not just during the pandemic, interest rates were just way too low for a whole host of reasons, some of them having to do with the global environment and so on. But when the cost of capital is basically zero, some really strange things happen in terms of the way that capital gets used. So we saw some strange things happen in terms of valuation, not just of fixed income securities, long duration, but also equity markets. I mean, there's a reason why equity prices were able to go as high as they did, particularly for long duration equities, i.e. the growth names, the tech names, where the PE multiples reached unprecedented levels. That in large part is a function not just of enthusiasm about earnings growth, but also the cost of capital, which was basically zero. The other thing that I'm concerned about, and I don't know if the Fed is or not, but they should be, has to do with a lot of the financial products that were put together with this very low cost capital. Some of the highly levered private product, for example, whether it's private equity, private credit, and so on. When interest rates begin to move up, I think we don't yet know all of the consequences of it. Those of us who are trained as economists like to look at simple things. Interest rates are going to go up. What's the impact on auto lending? What's the impact on home buying and so on? But I think there's going to be all this subterranean activity as well within the financial markets, and the most interesting moves may not be in the public markets. It could very well be in the private markets, and by definition, they're not particularly transparent.
Thank you, Abby. Trish, your thoughts on risk of over-tightening, financial instability?
Yeah. So I think I don't know if they're going to have to go to 6, but this is a very hard environment to engineer a soft landing. So I have to say I agree with Rick. It's not impossible, but sadly, I think given the geopolitical situation, it's pretty unlikely. The problem is if the US does this, and even if they don't go to 6, given the amount they're going to have to tighten just to get to neutral, which is what, 3, and they're presumably going to have to go a little bit beyond neutral. That's going to create a global recession, not just a recession in the United States. What's happening already? The dollar is appreciating, which means everybody who's making all those goods and services around the world and all the emerging markets, their currencies are depreciating. They are losing capital inflows. They are tightening. Actually, they're the ones who've been tightening monetary policy much more than the advanced economies, much, much more, frankly, partly in self-defense. Then they get a double whammy. The rest of the world does. So if you want, they get capital outflows, so they have financial distress, and on top of it, they basically end up importing a recession from the United States, partly because the U.S. is, the consumer for the rest of the world in many, many items. And if Europe goes into recession at the same time for slightly different reasons, it makes that situation even worse. So there's a real risk here that it could get pretty ugly. I also want to follow up on what Abby said, very relatedly, about debt overhang and financial stability. This is a massive risk. The corporate sector globally was over-levered walking into COVID. They did nothing but lever up with great encouragement and lots of loan guarantees, et cetera, and support from central banks and development banks, literally in almost every country in the world. Governments, as we all know from the fiscal policy, did exactly the same thing. Even small countries, if they had the fiscal space, they used every bit of it, basically, to support their citizenry during COVID and during lockdowns. If interest rates all over the globe go up, that is not necessarily a pretty picture for anybody. So I think there's actually a really serious, in addition to private markets where we don't even know what the leverage is, which I completely agree with Abby, I think this could happen, frankly, in public markets and even in a bunch of sovereign markets. If you ask me what keeps me up at night, if the Fed really, really can't engineer anything close to a soft landing, that worries me quite a bit.
Trish, I got to tell you that you're making me, I thought I was depressed. You're making me even more depressed.
So
Sorry.
I'd like to, we have a number of questions that take us in direction outside of monetary policy, but still focusing on inflation. And in particular, we have a couple of questions, one on energy supply and another question on supply chains more broadly. To what extent can this problem go away if there's within a reasonable amount of time through increases in energy supply, reduction in supply chain stress over the next year or two? And on top, let me maybe tag along one additional question that we see here in the chat, which is, what would you recommend the Biden administration do to the extent that it can do something about inflation? I don't know who wants to tackle that one first.
So let me maybe talk about the energy issues, which is, I think the reality is that certainly in the short term, I don't think there's much the Biden administration can do. I do think on the energy front, again, it's the issue of trade-offs, that I do think that climate change is an existential threat to the world. I think it's very, very serious. But there's a timing issue. And right now, I also think that what's going on in Europe in terms of Russia is also an existential threat, very short term. I don't think it's going to be a long-term one. There really is an issue about timing that given energy prices are so high, which I think will stimulate people looking for alternatives to using carbon fuels. There really is a question about in the short term that we might have to actually say the trade-off is such that we might not want to give up a little bit on the issue of climate change right now, but actually recognize that we have to then do more in the future. So I think that could help to some extent. Clearly, there's an issue about giving alternative energy supplies to Europe as fast as we can, particularly in terms of natural gas. But the reality is that this can change relative prices. Inflation still basically is a monetary phenomenon, and particularly in terms of the nature of the reaction to supply shocks. So unfortunately, a lot of the things that are coming out of the politicians' mouth about solving these problems by increasing supply and so forth, I think are really pipe dreams. But on the other hand, there is an issue over the next couple of years, how to think about how to manage some of these issues both from a point of view of helping in terms of getting increased supply and ameliorating some of the inflation problems, but also in terms of the new geopolitical situation that we're experiencing right now with Russia, which is that permanently, nobody's going to depend on Russia for their oil and gas in the future. This is a major shift in energy markets, and we have to think about what is the best way to handle that. And some of the good news here is the higher price and the fact that we're taking Russia out of these markets actually raises prices, which will encourage people to basically conserve on fossil fuels and actually, maybe even more importantly, develop innovation to actually allow us to actually exit from what fossil fuels sooner. So I think some of the trade-offs have changed as well here. And I don't know if the Biden administration is getting that. Because the opposite side tends to be the Republicans who deny climate change in many cases, which is not particularly helpful when it's really an issue about how do we manage the different trade-offs at different points in time. And that's important, just as I said, that I think the zero COVID policy in China made sense given the trade-offs that they had early in the COVID pandemic. I think it doesn't make sense now in terms of the way they're operating their economy. So trade-offs do change. As economists, we say that you then should operate differently. And I think that that has to get across to our politicians, although I don't know how we do that.
Trish, do you want to jump in?
Yeah, I was going to say something, excuse me. I was going to say something briefly about supply chains. I do think that supply chains will sort themselves out. It's not going to happen in weeks or months, but it will. Even if COVID persists, but let me explain what I mean by that. In addition to the geopolitical situation, which seems sadly more permanent, let's be blunt. One of the things that everybody learned from COVID is that the old just-in-time delivery of everything in global supply chains, of things coming from 200 places, is incredibly efficient and unbelievably fragile. So from a basic risk management standpoint, what do you want to do? You need to diversify that no matter what. That takes time and energy, and it's going to be, and resources. It is going to mean that things are going to be more expensive. So there's this part of what's been going on, of course, is, as all three of us have mentioned, is this price level adjustment. I think once that gets figured out, the global supply chain part of this is going to actually not be inflationary. The price level is going to be significantly higher, but not so inflationary anymore. So that's just an observation about supply chains. But it's not going to look like, we're not going back to what we had before. Frankly, that's just risky. If this were a financial institution and financial markets that did this, we would have said they were taking way too much risk with not enough capital. Is basically the things that in my view need to get fixed. I don't have strong views on the energy side, although I do agree with the comment that Rick made. I noticed there was a question about debt, and I don't know, Pierre, if you're going to get back to this, but there was a question about debt, and specifically in the United States. And the short answer to that is, yeah. Should we be worried about fiscal dominance? Depends on the difference between the real interest rate and the growth rate. Sorry, I'm going to use basic macro growth theory. If the real interest rate is persistently well above the growth rate of the economy, you have a problem. Everybody thinks that the large advanced economies are pretty much immune from this problem, particularly the US, because of the dominance of the dollar. It's not completely immune. Everybody who's old enough may remember that the first President Bush in the late 1980s basically didn't get reelected because they raised taxes, because basically the real interest rate on the debt was higher than the growth rate of the economy, because the Fed had tight policy and fiscal policy was too loose, and they had to tighten up fiscal policy. The problem with that, of course, is if we're going through a global recession, when you have to do that, that's not going to help you get out of the recession either. So I don't think that's incredibly likely, but it's absolutely possible, despite in some circles popular opinion to the contrary.
Let me just quickly add that the only bipartisanship I see in Congress is that both parties have not been serious about controlling budget deficits. I mean, it's during the Trump era, but you don't want to have very expansionary fiscal policy when the economy's booming, and that's what they did. And clearly, the Democrats are not worried about it. So, the Republicans are now saying, "Oh, we're worried about it," but that's only because the other party is in power. So, this is actually a real problem, and I agree with Trish that being complacent about it is not a good idea.
I'd like to jump in with some quick points, and maybe these are factoids, but I don't think so. The just-in-time supply chain issue is not just stuff, it's also people.
Mm-hmm.
The gig economy, which was supposed to be so helpful, was not good for workers. And we're finding out it's not good for the employers either. And an adjustment process needs to occur there. As I discussed earlier, there have been real slowdowns in the growth of available workers. Some of this is the labor force participation rate, which may readjust when people feel more comfortable after the pandemic. But a good deal of it is also related to the aging of the population in the developed economies, and also to the availability of immigrants. I hate to put this out there, but this migrant crisis with potentially 3 to 5 million Ukrainians having been displaced, if they find new homes in Europe, this is something that may in fact ultimately benefit Europe, just as the Angela Merkel's decision to accept immigrants into Germany a few years ago ultimately proved beneficial to economic growth there. The second point that I'd like to address is this idea about what the Chinese are now doing in terms of locking down their economy. Locking down their economy against COVID made sense early on because there was no vaccine. There are vaccines now. The Chinese just don't want to use the vaccines that are available outside China. The efficacy rate for Pfizer, Moderna, AstraZeneca, J&J are all 85% or better. Sinopharm is 25%. So if you insist upon using the local product that doesn't work, you're kind of stuck using these rather draconian lockdowns. And I think it's a bad mistake. People who I speak with say it's a horrible mistake from a public health standpoint. And I think we would all agree it's a mistake from an economic standpoint. And finally, with regard to debt levels, we all know the debt levels are high. On the corporate side, it's not quite as bad as it looks because we had a lot of very profitable, large multinational companies borrowing to the hilt when interest rates were basically zero and they didn't need the money. So they have an enormous amount of cash on their balance sheet and also debt on their balance sheet. So when interest rates begin to rise, I don't think it's going to be a problem for them in terms of the consequences of how they run their businesses. I think they were just making a financial decision and being opportunistic about it. I'm much more concerned about smaller companies who have higher cost of debt capital. I'm concerned about middle income families who have a problem with mortgages and so on. Keep in mind, a lot of wealthy families also borrowed and money that they didn't need. It was money that they were using to lever up investments and so on. So I think the impact of rising interest rates is going to be very uneven. Obviously, my comments just now were primarily related to the United States, but we have seen similar trends in others of the developed economies.
Terrific. Well, we've reached the conclusion of our discussion. And I want to thank our panelists for taking the time out of their day to be here with us. I know you all are eager to get to your dinners. And thank you for really an illuminating and insightful discussion on an incredibly interesting and important topic. And thank you to you all at home for joining us on behalf of the Richmond Center. Thanks.